All right, guys. Hi, my name is Darren Camas. I'm the CEO of IPOR Labs. And I think the last panel actually did a great job to set up kind of the narrative for IPOR. So if you guys are here, maybe I'll contextualize the name for you guys, especially if you're degens. So IPOR doesn't mean I am poor. IPOR borrows its name from a very nice TradFi narrative. If you've ever heard of the LIBOR, it's the London Interbank Offered Rate. It was used to structure around $350 trillion of deals, debt, and derivatives. So this idea of a benchmark risk-free rate is extremely important in TradFi, but the problem was the LIBOR was being manipulated by bankers for about 20 years. However, it's an important piece of the credit market infrastructure. So if we're looking about bringing data on-chain and off-chain, actually with the IPOR index, we take the best of DeFi and the best of TradFi. So instead of asking potentially corrupt bankers, we actually ask the smart contracts. So we find that DeFi has a much better narrative to structure actually the rates markets than inside of traditional finance. So we actually embrace the best part of decentralized finance. On the other side, we're talking about this sweet Ethereum yield. So again, if you guys are here and you're interested and you usually trade perps, you usually trade options, the whole other side of the credit market, the whole other side of the derivatives puzzle is the credit market. And the DeFi derivatives, the interest rate derivatives market is a $600 trillion market in traditional finance. It's the second largest market in the world to Forex. Okay, so if we look at IPOR, it's really kind of three things. First, it's data, then it's derivatives, and then it's on the road to structured products. So the IPOR interest rate swaps underwrite the money market rates. We have a swap construct that is underwriting the ETH staking rate, and pretty soon you'll be able to underwrite the restaking rate. But that's a whole different beast. So I'm guessing if you guys are paying attention here, the restaking rate is very interesting, but it can be extremely volatile, extremely risky. Okay, so we took this TradFi construct of the index rate, and we applied it to DeFi. We pulled it directly from the smart contracts. And to bootstrap this market, we developed a peer-to-pool interest rate swap. So instead of having two financial entities and a broker, actually we just have the peer-to-pool construct where the pool is the passive underwriter, the AMM prices risk, and the peer trades against the pool. Okay, so this is a visualization of actually the IPOR rate. So there's IPOR rates for USDC, USDT, and DAI. And this is a visualization of the rate dislocation actually about 1 year ago when the collapse of SVB, where you had a dislocation in the money market rates, also the DPEGs of USDC, the premium onto USDT. And so this is maybe a nice visualization of what interest rate volatility looks like inside of DeFi, how you could use interest rate derivatives to actually hedge against this risk, or how you could actually have some different volatility options, some spread trades, some straddles in there to actually profit from this volatility. And I think that this volatility is going to be something that we're going to see in the restaking rate. So right now, everyone's talking about restaking, but no one knows how to quantify the risk. So restaking, you get kind of this base Ethereum staking rate. You're also going to get a subset of different validator rates. And then you have the slashing risk. So my view is that it's going to look a lot like this and probably much more volatile. So the question is, how, if you're engaging in restaking, how do you protect against those risks? What are the derivatives going to look like? And then what essentially is this transition from the ETH staking rate, from the risk-free rate to this kind of risk premium that you can get in the restaking narrative? If we look at the DeFi credit market stack as this kind of software stack, it's nice composable structured products. So if you look at something like the IPOR derivatives, you guys are probably familiar with the money market side. You're familiar with the Aves, the compounds, the Morphos, the Oilers of this world. But you can take these nice composable instruments with the IPOR derivatives and base it off of the different rates. So this is what the derivative stack looks like inside of DeFi. So let's look at something like the Ethereum staking rate. So if we look at last year, what was the basis trade of last year? We had several funds that were spun up just to play this basis trade. The basic, you borrow ETH, you get the staked ETH, you leverage loop, and you farm the basis. But what's missing from these strategies is actually the hedging on both sides. So if you think of the IPOR protocol as the base of these structured products, you take a swap on the money market rate, you take a swap on the stake rate, and you can farm the basis at leverage. So this was a nice trade. It was the trade of last year. But in this upcoming, we have a couple of different narratives that are converging. And like the RWA panel talked about, we have this really big bent on RWAs. But RWAs are about to get a lot less sexy. We have the markets pricing in rate cuts towards the middle of this year. We have the market ripping. We'll see a lot more risk-taking inside of the DeFi credit markets, where you actually use the money markets to get leverage. And so what does that mean? We actually had an inversion of the TradFi rates, of the SOFR, of the Treasury rates, and the IPOR rates actually last July. But very few people are talking about this. So the macro narrative is we have macro rate cuts, and we have this kind of risk-on premium back in the money markets for unlevered stablecoins. And if you can do this leverage looping, you can actually sweeten that yield substantially. So we see the macro scenario being this essentially bridge of liquidity inside of decentralized finance. And then you have the DeFi native basis trade, which is going to move from the Ethereum borrow and the staking rate and this leverage looping to the Ethereum borrow and the restaking rate. So again, you'll get these nice these nice composable structured products where you have a hedge on the Ethereum borrow rate, where you have a hedge on the staking rate or the restaking rate, and you can farm the basis. You guys may know this guy talking about, I want to see how degens are going to think about speculating on interest rates. I think everyone's trying to find that native expression of an interest rate swap. And this is what we've been building at the IPOR protocol for the last 2.5 years. And right now, under heavy R&D, is the derivative for the restaking rate. So we launched the stake rate swap last December, and this is the one that's getting a lot of interest. So we were writing in between 50 and 100 million open interest on the stake rate swaps. It just launched on Arbitrum, and over the lifetime, it's underwritten over 4.3 billion. Okay, so this is the product market fit for those sweet ETH yields, right? We're going to move from this kind of leverage looping from the ETH borrowing rate, the money market rate, to the staked rate, to the restaking rate. But how do we price the restaking rate? Restaking is not so simple. I know how to quantify the staking rate. The staking rate comes from inflationary rewards, the monetary policy of Ethereum. It comes from the percentage of validators, it comes from execution layer rewards, and it comes from slashing risk. That's it. On the restaking side, we have a very opaque view into what these yields are. Right now, everyone's leverage farming points. Once those points become liquid, they have this real, tangible yield. But how do you quantify it? So right now, all of these unknowns, they're going to become liquid. And my view is that we're going to have this essentially different set of anywhere from shit quality bonds to investment tier staking services. And these are going to have various rate dynamics. They're going to have different rate, basically risk and rate returns. And I think that these are going to be priced very similar to credit default swaps. And so these are the interesting kind of products of the future that we're working on inside of IPOR, not only building these structured product loops, but it's also interesting to see what the derivative landscape will shape up like on the restaking side. So this is part of the product pipeline. Actually, it's maybe a bit out of date. So we launched on Arbitrum in January, just last month. ETH pool is coming up this week. We'll have a USDM pool that's also coming up in March. So if we tie this into the macro narrative, again, we'll have these rate cuts in TradFi, you'll have this risk on in DeFi. So you create the nice structured products where you can actually borrow against your treasuries and farm the basis between the treasury rates and the IPOR rates inside of DeFi. So this is something you can do in a very low risk, levered money market fund directly into DeFi. So that's this macro narrative, the convergence of rate cuts and risk on in the DeFi money markets. And then again, what is the shift in the sweet ETH yields going from the staking rate to the restaking rate? What are the risks? What are the ways that you can protect yourself? And what are the products that can be built to take advantage or essentially be insurance for the different providers, the different participants? So we have a diverse team with backgrounds in hedge funds, in different rates, environments, quantitative finance, some derivative exchange. So yeah, if you want to get involved in the IPOR community, the best place is going into Discord. We have a couple of different groups around the economic work group, which talks about token emissions, DEX liquidity, things like this. Governance work group. The governance work group, it focuses on things like, for example, different grant programs in not only in the side of the IPOR ecosystem, but also in other ecosystems. And it's also governance around the IPOR index itself. So right now, the IPOR is being updated, adding the Aave and Compound V3 markets, and for example, the Aave the Compound V2 is being removed from the USDC index. So there's this active group, and really next will be the markets and models group. So the markets and models, if you're interested in quant finance, if you're interested in modeling around interest rates, if you're interested in actually getting a very deep dive into the risks and rewards of the restaking, feel free to jump in the Discord and get active. Thank you very much. My name is Darren Camas. If you want to talk about interest rate derivatives, stake rate derivatives, and restaking derivatives, come chat with me afterwards. Thank you.